The email sits on an investor relations director's screen at 7:42 in the morning. The subject line is flat, the punctuation is deliberate, and the body contains no attempt at persuasion. It names a contract, a supplier, and a number. The director's first instinct is to delete it. 99% of unsolicited financial tips are noise. But he reads the second paragraph. The claim is specific. The math is shown. The contract number is correct. He forwards it to legal with a one-line note. Verify this. By noon, the verification team has confirmed the core claim. McDonald's has been overpaying for frozen chicken under supplier contract 47C by approximately 7%. The overpayment, compounded over 11 months across all domestic franchises, totals $419.8 million. The contract's pricing formula uses a reference index maintained by the USDA that lags the spot market by 60 days, a delay that benefits the supplier by exactly 60 days of higher pricing every time the market drops. The supplier knew. The contract was structured to hide it in plain sight. You have done this. You have looked at a receipt and felt the cold certainty that something was off. The rounding, the fee, the line item that did not match the conversation. You checked it again. You found the error. And when you presented it, the response was not gratitude. It was silence. Because the person who designed the error knew you would not check. Thomas did not have a receipt. He had a spreadsheet and a phone, and the patience to ask 3 cold storage facilities what they were buying chicken for that week. He averaged the 3 quotes. He compared the average to the contract price embedded in a public SEC filing. The difference was a flat line across months. The market reaction is not about the $420 million. The market reaction is about what the number proves, that McDonald's supply chain monitoring system, built over decades at a cost of hundreds of millions, missed a 7% overcharge for 11 months. If they missed that, what else did they miss? The stock drops 9% in a single session. $1.8 billion in market capitalization evaporates before the closing bell. The email did not hack a server, it hacked an assumption. The quants at the hedge funds who shorted the stock did not find Thomas. They found the leak in the contract. They read the email the same way the director did, but they acted faster. Within hours, multiple funds had run their own simulations. If a simple script had been monitoring the contract against the spot market, it would have flagged the discrepancy on day 60. The script did not exist. The discrepancy did. The funds shorted. The algorithm won before the company even knew it was bleeding. Thomas is sitting in a coffee shop in Indianapolis when the stock drops. He does not check the price. He is working on another discrepancy, a logistics contract for a regional grocery chain. He will send that email too. He never trades. He is not a trader. He is a supply chain auditor who lost his job during a corporate restructuring in 2018 and decided to use his accumulated knowledge of how large companies hide costs in plain sight. His edge is not data speed. His edge is knowing exactly where to look. McDonald's renegotiates the contract within weeks. They hire a third-party monitoring firm. They implement a real-time benchmarking system. But the structural lesson remains unlearned across the industry. The quants do not study Thomas's method because they cannot model it. It is too simple. It does not scale. It relies on a human asking a question no algorithm would think to ask. What does the market say, not what does the contract say? That question, asked once, cost $1.8 billion. Here is the contradiction. The institution spent millions on a system that checked compliance with the contract, but never checked the contract against reality. Thomas spent zero. He used a phone, a spreadsheet, and the willingness to be wrong 3 times before getting the right price. The institution's system was designed to prevent fraud. Thomas's system was designed to detect error. Fraud is rare. Error is constant. The institution optimized for the rare. Thomas found the constant. You have been inside this system. You have watched your own strategy, a simple rule, a single indicator, outperform the complex models you were told were necessary. You checked the results. You checked them again. You thought you made a mistake. The mistake was not yours. The mistake was in the assumption that complexity equals accuracy. It does not. Complexity equals vulnerability. The models are fragile. The simple rule, verified against reality, is not. The email body is 47 lines. The response as a memo board is 33 pages. The memo explores why the system did not catch the overcharge. It identifies 23 separate controls that should have flagged the discrepancy. Every control was functioning as designed. The design was the problem. The controls verified the invoice matched the contract. They did not verify the contract matched the market. That distinction between internal consistency and external accuracy is where the entire loss was hiding. That distinction, internal consistency versus external accuracy, is the gap most traders never even see because they are trained to trust the system, not reality. If you want to keep uncovering these hidden cracks, subscribe. And in the comments, write what you found when you last checked your own strategy against the real market instead of the model. Thomas is not a hacker. He is not a celebrity. He is a former auditor in a one-bedroom apartment who decided to ask a question no one else was asking. The question was not about chicken. It was about trust. He trusted the market price more than the contract price, and that inversion of trust, that choice to believe external reality over internal documentation, is the only edge that matters. The quants at McDonald's could not see the overcharge because they were looking at the wrong thing. They were looking at compliance. Thomas was looking at cost. The difference between those two words is the difference between a functioning system and a failing one. The email did not break the system. The email revealed that the system was already broken and that no one inside it had thought to look at the world outside. The board's 33-page memo arrived with an appendix. The appendix contained a single table, a side-by-side comparison of the contract price and the spot market price, month by month, for the past 11 months. The visual was damning. The two lines diverged in month 4 and never converged again. A high school intern with a spreadsheet, given access to both data streams, would have noticed the divergence within minutes. The intern did not exist. The system had no intern. The system had layers of approval, each layer checking the layer below, none checking the thing itself. This is the pattern. The more layers between the decision and the reality, the easier it is for a discrepancy to survive. The contract passed through procurement, legal, supplier relations, finance, and accounts, payable. Each department signed off on its own piece. Procurement checked the price against the contract. Legal checked the contract against precedent. Finance checked the budget against the forecast. No one checked the contract against the open market. The system was staffed with specialists. No one was generalist enough to ask the one question that would have broken the illusion. Thomas understood this because he had been inside it. He spent 7 years as a supply chain auditor for a multinational food distributor. He watched contracts pass through departments like a baton in a relay race, each handoff adding legitimacy, none adding truth. He saw a purchase order for stainless steel fittings that was 3 times the market rate, approved by 5 people, paid without question, and only discovered when a junior accountant cross-checked it against a competitor's catalog by accident. The fitting was never recovered. The money was long gone. The process remained. The quants at the investment funds studying the McDonald's event created a model to predict similar contracts across other large food service companies. They fed in contract pricing, supplier concentration, and the frequency of third-party audits. The model returned a list of 37 companies where the structural conditions for a hidden overcharge were present. The model could not tell them which contracts were overpriced. It could only tell them where to look. That was enough. The funds deployed analysts. Within 6 months, 3 of the 37 had disclosed similar discrepancies. The model worked. But the model was built after the fact, after Thomas had shown them what to look for. The empty office in Indianapolis was not empty by design. Thomas worked there because the rent was $200 per month, and the landlord did not care what he did. The room had a plastic folding table, a camping chair, and a power strip. The internet was paid for by the month. The heat stopped working in December. He wore a jacket inside until March. This was not romantic. This was not a scene from a film. This was a man in a cold room reading SEC filings on a 7-year-old laptop, cross-referencing supplier prices against public commodity indexes, and writing emails that no one had asked him to write. He sent 8 emails total. 5 were ignored. 1 received a polite but generic response. 2 triggered internal reviews that resulted in no action. The 8th was the McDonald's contract. The eighth was the one where the timing, the data, and the market fragility converged. He did not predict that convergence. He could not have predicted it. He simply sent the email and moved to the next contract. The $1.8 billion drop was not Thomas's goal. It was a byproduct of his persistence. The persistence itself is the part the quants cannot replicate. Persistence does not scale. You cannot algorithmically generate the patience to spend 2 years in a cold room reading SEC filings. You cannot model the willingness to send 8 emails knowing that 7 will be ignored. The institution builds systems that amplify effort once the target is identified. Thomas built a system that survived the 90% failure rate of the identification process itself. That is a different kind of architecture. The architecture of the cold room and the folding table is not scalable because it was never meant to be scalable. It was meant to be sufficient. Sufficient does not mean small. Sufficient means capable of surviving long enough for the one convergence to occur. Thomas's edge was not intelligence. His edge was duration, the ability to remain in the game long after everyone with a better setup had left. You have felt this. You have watched a position sit flat for weeks while your conviction eroded and your margin tightened. You closed it. You watched it move the following month. The move was not for you. It was for the person who waited longer. Duration is invisible. It does not show on a P&L statement. It does not appear in a 1-month return. But over 2 years, across 8 bets, duration is the only factor that determines whether you are still in the room when the convergence arrives. The quants at the funds who shorted McDonald's did not wait. They acted within hours. They made a profit within days. They closed within weeks. Their edge was speed, not duration. Thomas's edge was duration, not speed. The market rewarded both. But the market rewards duration differently. It rewards duration with the outsized return that comes from being the first person inside a discrepancy that everyone else will later deny existed. You have just watched duration beat speed. You have watched a man with a folding table in a cold room wait out an industry. If you want to see where this pattern shows up next, in markets nobody is watching yet, subscribe, because the quiet edge is always the one nobody talks about until after it works. And in the comments, tell me, what position did you close too early? And did it move the month after you left? Oh, the denial is the final layer. McDonald's initial public response did not mention Thomas. It mentioned an internal review, a contract renegotiation, and a commitment to enhanced monitoring. The investor relations team framed the $420 million as a recovery, a discovery made by the company's own systems. The systems did not discover it. An email from a former auditor in Indianapolis discovered it, but the narrative required the institution to appear in control. The control was fake. The narrative persisted. Multiple journalists attempted to profile Thomas. He declined every interview. He told one reporter, by email, that he had nothing to add. The story was in the contracts, not in him. He was right. The contracts contained the entire story. The contract number, the clause, the reference index, the lag, the difference. The human element was simply the person who decided to look. That decision is not a story, it is a function. And Thomas, like the bot that waits, was functioning as intended. The function is not complex. You are already doing something similar. If you have ever watched a chart for an hour and seen nothing, close the window and come back the next day to find the entry you had been waiting for. You understand the mechanism. The mechanism is not analysis. The mechanism is presence. The system, whether a contract or a market, functions normally until it does not. The person who is present at the moment the function breaks has a choice. Thomas wrote an email. You executed a trade. The machine that runs the system cannot make that choice because the machine does not know the system is broken. The machine checks compliance. The machine does not check reality. The machine's blind spot is structural. The McDonald's contract checking system was built by the same company that wrote the contract. The system could not challenge the contract because the system was an extension of the contract. This is the worm eating its own tail. The institution creates a tool, then trusts the tool more than the environment the tool was designed to measure. The tool becomes the reality. The actual reality, the price on the open market, the spot price, the bid-ask spread of a commodity that trades every day, becomes secondary. The tool wins until a Thomas appears and compares the tool to the world. The investment community learned from the McDonald's event. They built the model, they deployed the analysts, they shorted the 3 companies that followed, but the learning was superficial. They learned to look for the same pattern in the same industry. They did not learn to ask Thomas's question. What else are large institutions trusting without verification? If they had, they would have found the logistics contract, the steel procurement, the raw material index in a mid-cap manufacturing firm that had been overpaying by 8% for 14 months. The discovery of that overpayment did not trigger a stock drop. The company was too small, but the mechanism was identical. A single person outside the system asked a question the system was not designed to answer. The system answered with silence. The reality answered with a number. The person chose to believe the number. That choice, repeated across enough contracts, becomes a system of its own, a system that cannot be gamed because it does not trust the game. The quants built a model to find the next McDonald's. They found 3, but they missed the deeper pattern because their model was searching for the same crime, not the same method. Thomas's method was not specific to chicken contracts or lagging USDA indexes. His method was generic. Compare the internal price to the external price, and if they diverge, ask why. The quants modeled the divergence. They did not model the question. The question is the only part that travels across markets. The question travels because it does not require a specific data source. It requires only a hypothesis that the internal and external might differ. That hypothesis is not expensive to test. It costs 3 phone calls, or 1 web search, or a 5-minute comparison of 2 public documents. The cost is so low that institutions ignore it. They assume that if a discrepancy were real, someone inside would have found it. The assumption is wrong because the people inside are not looking for discrepancies. They are looking for errors in the system defines as errors. An overcharge that matches the contract is not an error by the system's definition. It is a feature. You have encountered this. You have placed a trade based on a signal that your platform confirmed is valid and watched the position move against you for reasons the signal could not explain. The signal was correct. The platform was correct. The contract, the exchange rule, the liquidity condition, the fee structure was designed so that the signal would fire at the wrong moment. The signal was executing its function. The function was the trap. The system that built the signal was also the system that set the trap, and the two could not be separated by any layer of verification inside the platform itself. The separation requires external reference. Thomas used the spot market. The spot market did not care about McDonald's contract. The spot market was 1 million independent transactions every day, none of them aware of supplier contract 47C. The spot market was the truth. The contract was a story about the truth. The two diverged, and the divergence was invisible to everyone who trusted the story instead of the truth. The same divergence exists in every market where contracts replace discovery. When a large institution signs a long-term supply agreement, it replaces the continuous discovery of the open market with a fixed formula. The formula is an assumption. The assumption may be wrong from day one, or it may become wrong over time as the market moves. The institution does not check because checking would mean admitting that the formula, the contract, the relationship, the years of negotiation might be inferior to a simple price feed available to anyone with an internet connection. The cost of that admission is higher than the cost of the overpayment. Thomas had no relationship to protect. He had no contract to honor. He had only the question and the willingness to be wrong. That combination, no stake in the existing arrangement, no reputation to preserve, is the only combination that consistently finds discrepancies. It is also the only combination that cannot be hired, trained, or automated. The institution cannot employ someone whose loyalty is to the question rather than the organization. The question is too dangerous. The question, if answered honestly, may demand action that contradicts the institution's own interest. The McDonald's board understood this. The 33-page memo did not recommend hiring a Thomas. It recommended tightening the existing controls. The controls were already tight. The controls were the problem. But the memo could not say that because the controls were designed by the people writing the memo. The system protects itself by defining the question it can answer as the only question worth asking. Thomas asked a different question. The system had no response. The funds that shorted McDonald's understood this better than the board. They did not try to hire Thomas. They tried to replicate his method. They built a model that scanned contract language for pricing formulas tied to lagging indexes. The model found candidates. The analysts called suppliers. The analysts asked for spot quotes. The analysts compared. The process worked because the funds did not have a reputation to protect. They had a profit motive, and the profit motive aligned with the truth. The alignment is temporary. The profit motive will shift when the discrepancy closes. The question will remain. The question remains because the structure that produces the discrepancy does not change. Contracts will always be written by parties who benefit from the fine print. Formulas will always contain assumptions that favor the drafter. The lag will always be hidden in plain sight because the language that describes it is technically accurate. The truth will always be available to anyone willing to leave the building and ask the market what it is paying. The building is the trap. The market is the release. Thomas is still in Indianapolis. He is still reading SEC filings. He is still making phone calls. He has sent more emails. Some have been ignored. Some have triggered reviews. None have triggered another $1.8 billion drop. He does not expect them to. He expects the pattern to continue, a long series of ignored warnings punctuated by rare, explosive confirmations. The pattern is the system. The pattern is also the edge. The pattern repeats. Thomas's ignored warnings, then the explosion. That rhythm is your edge if you recognize it before the crowd does. Subscribe if you want to catch the next quiet signal before the algorithm floods in. This channel exists to show you what the building hides. Drop the word pattern in the comments if you have seen this cycle play out in your own trades, because the confirmation is rare, but it is real when it lands. You have lived inside this pattern. You have placed trades that went nowhere for weeks, then exploded in one session. You have held positions through drawdowns that felt final, only to see them recover and exceed. You have watched your simple rules outperform complex models over long enough time frames to make the complexity look foolish. The pattern is not magic. It is the natural consequence of trusting external reality over internal story. The market pays for that trust. It pays rarely. It pays generously. The quants at the funds who studied Thomas stopped studying him after 6 months. He had no more lessons to give them. They had extracted the pattern. They had deployed the model. They had shorted the companies. The model worked. They moved on. Thomas did not move on. He is still in the cold room. The heat still breaks in December, reading the next filing, making the next call, writing the next email. He will be there when the next convergence arrives. The quants will not. They will be looking for the next model. The model will find the next pattern. The pattern will not be the same as the last one. The question will be, the quants modeled the pattern. They modeled the divergence. They modeled the contract language. They did not model the cold room, the folding table, the jacket worn until March. Those details cannot be modeled because they are not data points. They are conditions. Conditions cannot be simulated. They can only be endured. The institution designs systems that eliminate the need for endurance. Thomas built a life that required nothing but endurance. That life is not scalable. It is not desirable. It is, however, irreducible. The irreducible element is the willingness to be wrong 7 times and send an 8th email anyway. The institution cannot code that willingness because the institution defines success as a high hit rate. Thomas defined success as 1 hit that justified the 7 misses. The ratio is inverted. The institution optimizes for consistency. Thomas optimized for asymmetry. The asymmetry was the edge. The asymmetry is always the edge. You have been optimizing for the wrong ratio. You have been told that winning requires a high percentage of correct trades. You have believed that a 60% win rate is good and a 70% win rate is better. The McDonald's contract disproves that assumption. 1 email produced a $1.8 billion market move. The 7 emails that produced nothing were not failures. They were the cost of the one that worked. The cost was time and attention. The return was a multiple that no win rate calculation can capture. The asymmetry is not unique to supply chain discrepancies. It is the structure of any market where outliers determine returns. A single trade can outweigh a year of losses. A single position can define a career. The institutions design their systems to avoid the single loss. They build diversification, hedging, risk controls. They eliminate the possibility of the catastrophic loss. They also eliminate the possibility of the asymmetric gain. You cannot have one without accepting the other. Thomas accepted the other. He accepted that 7 emails would vanish. He accepted that no one would respond. He accepted that his work would be invisible for months, then suddenly visible to everyone. He accepted the asymmetry before the asymmetry paid. That acceptance is the discipline that the quants cannot code, because it requires a relationship with failure that no model can evaluate. Failure is not a data point to a human. It is a cost. If you are not willing to pay it in advance, you will not be present when the divergence arrives. The divergence arrived for McDonald's on a Tuesday morning in January. It arrived because Thomas had been present for 18 months before that Tuesday. The presence was not rewarded during the 18 months. It was rewarded during the 30 minutes between the email being opened and the stock beginning its drop. The reward window was narrow. The presence window was wide. You do not know when your window will open. You know only that it will not open if you leave the room. The room is not a physical location. The room is the willingness to keep checking, keep comparing, keep asking the question that no one else is asking. The room is the refusal to accept that the system's answer is the correct answer, just because the system delivered it with authority. The room is the conviction that the external reality, the spot price, the bid-ask spread, the traded volume, the actual exchange of value between two willing parties, is more reliable than the internal story told by a contract, an algorithm, or a quarterly report. Thomas did not trust the contract. He trusted the phone call to a cold storage facility in Indiana, who told him the price of frozen chicken that morning. That trust was not sophisticated. It was not technical. It was a choice. He chose the external over the internal. He chose reality over documentation. He chose the market over the model. That choice is available to you in every trade, every contract, every position you consider. The market is the truth. The model is a story about the truth. The story is useful until it diverges. The divergence is inevitable. The only question is whether you will be looking at the story or at the market when it happens.